Welcome to the Stock Market Palantir. Today, we are going to talk about LUNR, Intuitive Machines.
And this is a company that isn't just, seeking to raise capital or announce a new mission. It's undergoing a total corporate identity overhaul. LUNR has really placed itself at the epicenter of the question, can a successful yet highly specialized new space pioneer actually pivot into a vertically integrated aerospace giant, what we'd call a space prime?
And that attempted pivot, that's really the heart of the matter here. The action defining this change is the $800 million acquisition of Lantis Space Systems, which, our listeners might remember as the formerly storied Muxar Space Systems from Advent International. This is not just strategic alignment. It is a full-scale corporate metamorphosis.
And that massive strategic gamble brings us to the core question for today. Does the, undeniable strategic value and the immediate large-scale contract revenue you get through the Lantis acquisition truly justify the technical execution risks, the severe financial dilution facing shareholders, and frankly, the extreme market volatility that's defining LUNR stock right now?
I'm going to argue that this transformation provides an immediate and formidable valuation floor, and it's backed by revenue certainty. By acquiring decades of flight heritage, LUNR is transitioning from a speculative, almost binary lunar lottery ticket into a robust, long-term space infrastructure play. A credible space prime.
I'm just not convinced that buying legacy assets cures the underlying disease. The repetition of technical execution failures in their core business, specifically their lunar missions, that combined with severe shareholder dilution, it just creates an unacceptable risk profile. It raises serious concerns about management's fundamental technical competence, which is the one metric that truly drives trust and valuation in aerospace.
Okay, so let's unpack the value of what LUNR actually purchased here. The Lantis acquisition is a decisive move. It allows LUNR to secure space prime status almost overnight, bypassing decades of internal research and development. And when we say space prime, we mean becoming an established, reliable defense contractor, like a Boeing or a Lockheed, with proven, standardized orbital infrastructure.
Okay, I appreciate the definition, but decades bypassing is a very expensive shortcut.
But it's necessary. The crown jewel here is clearly the 1300 series satellite bus. And this is not minor technology. This is the platform for heavy geostationary or GEO satellites, the most valuable real estate in orbit. It has over 90 units successfully in orbit. That immediate proven flight heritage and reliability is, it's invaluable, especially for winning those high-margin national security contracts that demand zero tolerance for failure.
I see why you emphasize that heritage. It's a compelling asset. However, that security comes at a colossal price that lands squarely on existing shareholders. We are talking about $350 million in equity used to finance this deal, which implies the issuance of approximately 30 to 35 million new shares. That balloons the total share count from about 117 million to well over 150 million. That level of dilution is just incredibly painful for anyone holding the stock today.
That's an important point about the dilution, I get that, but I would frame it as a necessary cost for securing control and stability. The deal also brings the massive Palo Alto manufacturing facility in-house. So by owning the factory, LUNR now captures the manufacturing margin and secures crucial supply chain control for its own future near-space network services, the NSNS constellation.
The numbers still hurt, though.
But look at the pro forma financial profile. The combined revenue for the merged entity exceeds $850 million, and the secured backlog jumps to $920 million. You're exchanging dilution for visibility. This isn't speculative revenue based on future launches. This is hard, contractual revenue tied to highly successful orbital platforms. And what's more, the acquisition provides immediate access and contractual vehicles for the national security market, specifically the Space Development Agency's layered architecture programs. It immediately diversifies revenue away from that single-threaded dependence on NASA's CLPS lunar budget.
Okay, while revenue visibility is improved, the market's primary focus and, frankly, the primary valuation driver for any aerospace company remains flawless execution. And LUNR has repeatedly failed that core test in the most public way possible. The IM-2 Athena mission demonstrated that they have systemic guidance, navigation, and control GNC issues. You can buy all the infrastructure you want, but if you can't fly your own missions competently, investor trust is just going to erode. All right, let's start the core debate by drilling into the LUNR deal itself. Strategically, I agree it was probably necessary to escape that lunar lottery image. But the financial and cultural execution risks are staggering. You are merging an agile, often quick-moving new space lunar startup with a legacy aerospace division that was the established, methodical manufacturing heart of Maxar. How do you possibly reconcile those two entirely different corporate cultures?
That's a key risk, sure, but the financial structuring, I think, mitigates the immediate pressure. I'm not convinced the integration risk is insurmountable, especially when you look at the deal's financing. The $450 million cash portion was funded primarily by a $345 million convertible note issuance. This shows LUNR's ability to deploy aggressive capital without incurring the heavy, high-interest debt that has crippled other space ventures. The transaction multiple itself is also highly attractive. We're talking less than 1x projected combined revenue, which is a significant discount compared to established defense primes valuations. They really got a bargain on the assets.
A bargain is only a bargain if you can successfully integrate it. Bank of America, which is a major skeptic here, maintains an underperform rating precisely because of the, and I'm quoting, lumpiness of these acquired cash flows and the sheer high execution risk of merging these two disparate cultures. You cannot just smash a Silicon Valley startup culture into a decades-old process-driven aerospace manufacturing environment without suffering significant internal delays and friction. That integration failure itself could cause the stock to crater, regardless of the backlog.
But management has taken specific steps to address that cultural friction. They retained Chris Johnson, a veteran executive from Boeing's satellite division, to run Lanteris. Management explicitly stated that the goal is not a hostile takeover or a corporate gutting, but rather feeding the established production line with new growth-focused contracts. This is about leveraging existing operational efficiency, not reinventing it. That leadership continuity should mitigate those cultural risks.
That's a compelling argument for operational continuity, I'll give you that. But let's look closer at those convertible notes, the ones funding the cash portion. They represent a significant sword hanging over the company until 2030. It's a financial trap with two teeth. If the stock appreciates significantly, say due to future mission success, shareholders face massive, uncontrolled dilution as the notes convert to equity. Conversely, if the stock languishes and fails to hit conversion targets, the company faces a major repayment hurdle, a $345 million cash outflow 6 years down the line. They've basically traded short-term borrowing risk for long-term equity or liquidity risk.
But the sheer time horizon, we're talking 2030, gives them ample opportunity to realize the synergy benefits from the acquisition, to organically grow the cash flow from that $920 million backlog, and to manage that debt proactively. The risk is priced into the notes, and the optionality of having the capital now to secure that space prime status, well, it far outweighs the 2030 maturity risk in my view.
Let's shift our focus to the elephant in the room, operational competence, or the lack thereof, as proven by IM-2. The failure wasn't a minor glitch. It was systemic. The lander tipped over at Mons Mouton, and it operated for less than 24 hours. The cause was altimeter signal distortion interacting with highly complex terrain at the lunar South Pole. This repetition, it mirrored the IM-1 partial success, is what shifted market perception from pioneering struggle to a genuine competence crisis. Scientific objectives, things like the Prime 1 ice drill demonstration, were rendered inconclusive.
The market is focused on the wrong signal entirely. While the market saw failure and reacted brutally, the stock collapsed over 20% plus another 27% in after-hours trading. NASA, their primary customer, publicly categorized the IM-2 mission as a success. Why? Because crucial engineering and payload data was returned from the surface. There's a clear institutional divergence here between customer satisfaction and short-term market expectation.
Customer satisfaction is great, but customers aren't buying the stock. Investors are, and those investors are responding to the fundamental operational risk.
And they are also responding to proactive risk mitigation. LUNR simultaneously acquired Kinetics, a company specializing in deep space navigation expertise, specifically to directly address these systemic GNC challenges. They recognized the weakness and they bought the expertise needed to fix it. That shows responsible management.
Kintex is a small, tactical acquisition compared to the massive strategic Lantris move. It's a bandage on a severe wound. The key point is that the lander remains highly fragile, and the core LUNR business is what still generates the most news and the most volatility.
And that's precisely why the Lantris acquisition is so essential. The failures of the lunar lander become less fatal to the company's valuation because the future revenue profile is anchored by the $4.82 billion NSNS contract. That contract relies overwhelmingly on Lantris's orbital infrastructure, the satellites, and the 1300 series bus. The lander is only the tip of the spear now, not the entire corporate body. The 1300 series bus is proven in orbit. The lander failures, while painful, no longer threaten the company's existence. Now, moving to the technical market structure, I would argue that sophisticated investors are looking beyond the operational noise and they're buying into the long-term infrastructure thesis. And this view is supported by institutional accumulation. BlackRock, for instance, increased its position by 94.5% in Q2 2025. This is smart money buy-in. It signals confidence in the space prime narrative over the short-term GNC concerns.
Smart money is accumulating, yes, but how they are accumulating is a major concern. We are seeing extremely high dark pool volume, 44.64%. This suggests institutions are quietly accumulating off-exchange to avoid signaling their intent and, well, to keep the price suppressed. The result is that retail investors see that dark pool volume and they feel frustrated because good news doesn't move the stock on the lit exchange. That frustration contributes to the volatility.
But that high dark pool accumulation acts as a future propellant. When that institutional position is eventually fully reported and stabilized, the price will have a much higher floor for expansion. Furthermore, you have external validation. Analyst targets from Stifel and Roth MKM are highly bullish, calling for $18 and $20 respectively. They view the stock as deeply undervalued relative to its new, high backlog and its space prime status.
Well, those analyst models are based on ideal execution and synergy realization. The market, however, is trading based on operational trauma. This is a classic battleground stock. The evidence is right there in the highly elevated short interest, sitting at 26% of the float. That means over a quarter of the available shares are being actively bet against.
And that 26% short interest creates the potential for a major short or gamma squeeze of positive news breaks. That upside potential is enormous.
Days to cover for the short position suggests shorts are determined and they're entrenched. And let's not overlook the underlying liquidity strain implied by the spike in fails to deliver the FTDs over $16.65 million, recorded in just a 15-day period. This suggests market participants are struggling to locate and settle shares, which is a major red flag for ongoing volatility and market mechanics risk. The gap between those optimistic analyst models and the brutal market reaction to IM2 shows that operational execution still drives the share price, not the promise of space prime status.
The tension is clear. Institutions are accumulating assets based on the acquired backlog and infrastructure, viewing LUNR as a space prime, while short sellers are leveraging the demonstrated technical flaws to attack the volatility. To summarize my position, LUNR remains a high-risk, high-reward proposition, but the acquisition of Lantris fundamentally changes that risk calculation. It represents the essential transition from speculative space exploration to financially stable space infrastructure. The purchase revenue backlog, the 1300 series flight heritage, and the manufacturing facilities provide a formidable valuation floor that ensures the company is no longer solely dependent on the binary outcomes of lunar landings. The cost of dilution is justified by the stability purchased.
And while I find the infrastructure thesis compelling, I believe investors cannot ignore the persistent, real, and potent technical execution risks, as we saw with the IM2 outcome. Investors must consciously weigh the significant shareholder dilution and the threat posed by volatile market mechanics, that entrenched 26% short interest and the convertible note trap. Against the future potential of the space prime transition, operational risk remains the dominant, brutal driver of the share price today.
Ultimately, LUNR's success really hinges on two separate but equally complex factors: flawless integration of the legacy Lanteris business in the upcoming quarters, and crucially, flawless GNC execution on future missions like IM-3, proving they have learned from their failures.
The core question remains whether the strategic transformation via Lanteris provides a sufficient shield against the persistent dilution and operational risk that stems from their high-profile yet high-failure rate core LUNR business. It's a fantastic company built on assets, but one trading based on fear.
So we've established two powerful evidence-based perspectives here. One viewing LUNR as a robust, diversified infrastructure prime, thanks to the Lanteris assets and backlog. The other seeing the core operational challenges and market volatility as insurmountable barriers until technical confidence is restored.
And the path LUNR takes, operational success or failure in the near term, will determine which of these models ultimately guides the stock price.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.